So I have a small quiz. I have a small quiz. Between 2000 to 2018, in last 18 years, Infosys and Marico, two companies, profit growth has been 25% for 18 years in Infosys. 25% compounded for 18 years is like a almost impossible kind of event, but it has happened. And Marico about 18%. Now, what could be the return in both the companies, starting from 2000? So 2000 to 2018, I'm giving a primer in terms of earnings growth. What could be the return? Anybody has 30? 30 for 18 for Infosys? Marico. Bata? No, what is the CAGR? For Infosys? Marico. And this one? 10, 11%. I think since he has suffered, he knows it the best. So, see the numbers. It's 8% for Infosys and 30% for Marico. It's all game of valuation. And you know why it has happened? The P differential. In 2008, it is not 2008, I'm sorry, this is 2000. It's a mistake. It's 2000, in 2000, the P was 206. That was the peak of dot-com boom. And 16 is the P in 18 March. From 206 to correct in 18 years, it literally the overvaluation of the stocks. I mean, this actually makes you think. Because if you had a perfect foresight in 2000, that for next 18 years, Infosys is going to grow at 25%, and yet you would have not made any money. And forget about beating the market. You would have been lucky to just save yourself at a fixed income rate, if you're right for 18 years. And look at Marico, which was a kind of a good company, known company, small company. It was very respected company even then. At 10p when you bought, and the re-rating of 54p, 5x. That is the game of valuation. The guys who understood the valuation in 2000, they kind of walked out of the stock. And the guys who understood again the valuation of Marico, they bought into it. And I think we have a gentleman called Sanjay Bhattacharya. He suffered as well as benefited in both the stocks. That's why I picked up these two companies. So just to set the backdrop, in the Bible it says, I mean, this is the best quote on valuation ever heard. In the Bible it says that love covers a multitude of sins. Well, in investing field, price covers a multitude of mistakes. For human beings, there is no substitute for love. For investing, there is no substitute for paying the right price. Absolutely none. So this is Vandenberg, 95-year-old Century Investment Management in Houston, I think. He works out of Houston, very old guy, Second World War veteran. So this guy, you know, is amazing in terms of his insights about investing. But this price thing is so important. You just saw so it is very important to understand I just wanted to give the backdrop in which we have done the study, and we'll get back to this a little later. So this entire presentation is in two parts. Wealth creation findings, the last 5 years, what has happened, just to warm up, and then the valuation insights. So concept of wealth creation is the process by which a company enhances market value of the capital entrusted by it to shareholders. This is the biggest game in town. All the richest guys in the world, whether it is Google guy or Amazon guy, all of them, they have made money. Their billions they have made through the entrepreneurship, whereby few $1,000 or few $1 million, which have been given to them to start the venture, has become almost $1 trillion or $500 billion. That kind of enhancement of value happens. It's a literally magical thing. And the market system, the way it has been created, I think it is the biggest game in town, and it is becoming even bigger in India and at a very rapid pace. So that's what we wanted to study. And net wealth created is the change in market cap over period 2013 to 18, adjusted for whatever money company has taken during this period. The amount of wealth created is growing every year. In this last 5 years, between 2013 and 18, it has created about 45 lakh crores. This is the extent of wealth created in the last 5 years. Every 5 years, you see the amount of nominal wealth which has been created about, it is growing rapidly. Now it is 45 lakh crores. Let me just give you the total market cap today is about 135 lakh crores. So it is literally 1/3 of the current market cap which has been added in last 5 years. The pace at which the wealth has been created for these 100 companies is at the rate of 23%, whereas the market has grown at about 12%. We have put all these 100 largest wealth creating companies into 3 buckets: biggest wealth creators, fastest wealth creators, and most consistent wealth creators. The biggest wealth creator is HDFC Bank. We were waiting for last 3-4 years. I mean, this is the bank I saw taking birth. This is the bank where I applied in IPO. Probably only time I applied in IPO, I could see this bank becoming very large. Little I knew. I mean, the story is very bad for me. I bought at 40, sold at 52. I had few lakh shares, and the story is a little longer, but I'm so happy to see this bank becoming number 1 at just 3 lakh crores, 3.5 lakh crores addition to the market cap in last 5 years on a back of just about 2.5 lakh crores. So right now, it's about 5.5 lakh crores, and it is the most popular stock in almost all the portfolios at 8-9% allocation. So it goes to their credit. Reliance Industry, we know, it is the largest private sector company now. TCS. So these 3 are continuously, I mean, HDFC Bank for the first time become number 1 wealth creator, and I think there's a momentum out there. TCS is again making a comeback, and they could, I mean, if there is resurgence of their growth, they can again surpass because they're very large on the base. And TCS has already done for 5 years the largest wealth creating. Of the other 10 companies, I mean, Bajaj Finance is looking to be having the highest momentum right now. It is the 10th largest, first time it has come, and the growth rates are running at 40-50%. Even Maruti is at about very interesting situation of very large dominant position in a high value item. Rest all L&T could surprise us because now the capex boom is starting. Today we saw the return. See, you have to get the first, what is going to be number 1 in next 4-5 years. And they are all going to come from this top 10. Very unlikely that they will not be in top 10 today, which is going to become next largest company in next 5-6 years. So I would think Bajaj Finance will take some more time, but L&T and Maruti could give a push to somebody in next 4-5 years in different conditions. This is the most, this is the crazy kind of list where the fastest wealth creating company, India Bulls Ventures, has gone from 189 crores in 2013 to 12,000 crores, at literally doubling every year in last 5 years. And leaving aside that, I know very little about this company, but if you see the other companies, whether it is Dalmia Bharat, TVS Motor, this is the only company from mini to mega, 80% compounded. HEG, which is a very recent phenomenon in last 2 years. Sterlite Technologies, Bajaj Finance. Bajaj Finance is one company which is in the largest and the fastest. And then very close, our own Motilal Oswal is 7th largest. Funny to see it here. Motilal Oswal has grown at the rate of 67%. So actually we have not grown that much, but just if your purchase price is so low, you bought it just about 10-12 P multiple with a market cap of just 1115 crores in 2013, which went to as high as 20,000 crores in 2018. Then IFL Holding, NBFC and Eicher Motors. So you have kind of a very nice list of fast-growing companies, which is quite of rare. Then you have the pristine list of all the evergreen, consistent wealth creating companies. And here the real honor goes to Titan at 33% compounded in last 10 years actually. This is a 10-year kind of wealth creation, 33% compounded. Guess how much it has done? 17x in 5 years. Sorry, in 10 years. 17x in 10 years. And the P multiple re-rating has gone from 30 to 73. You look at all the P multiples of these companies in last 10 years. I mean, Godrej Consumer has gone from 20 to 51. Shree Cement has gone from 13 to 42. I mean, all of them, except for probably HDFC Bank, which has just moved from 29 to 27. Rest all have been massively re-rated. So, this is the most pristine set of companies. I would have said, every time I say that if you build a portfolio of these 10 companies, they will beat every single index and most of the fund managers. But looking at the current valuation, I'm not too sure whether that, I mean, yes, you'll do very well. Probably you'll beat the index, but not by huge margin because the price you're paying is too high. The sectors which have done very well is financials. Look at almost 27% of all the wealth created. Out of 45 lakh crores, 12 lakh crores has been created by financials, private sector financials basically, because actually the biggest destruction has happened in the public sector financials. And then consumer, and then oil and gas and auto. These four sectors, typically it used to be the IT, pharma, and consumer. That trio used to be the biggest wealth creators, but this time it is financials, consumer, and oil and gas. So and auto. But whole lot of companies like capital goods are like very small. Cement is very small. Telecom is literally non-existent. I think these sectors, they are overdue for churn. Whether it happens in next wealth creation study, but I would think that 5 years henceforth, this list could look very different because we are in just the early stage of capex cycle. Wealth creation by PSU remains absolutely negligible, and in 2004-5, almost 40%, 50% of the, in 2005, 50% of all the wealth created was done by PSUs, which is reduced to now 8-9%, and this is also because of resurgence of oil sector. Otherwise, it is reduced to nothing. And now if you do it in 6 months' time, today if you do it, I think it will come to about 1 or 2%, because whatever little was there in March, that is also demolished. So I think this has been the biggest disappointment in the market, and it has also contributed to non-performance in recent times for all the corporates. Now, this is one slide which we have done for the first time. This is the spectrum of how the multinational companies and PSUs, they were dominant. In 1998, 36% of wealth was created by PSUs, 23% by multinationals, and only 41% was by Indian entrepreneurship. The pure Indian enterprises like HDFC Bank, Sun Pharma, TCS, Infosys, Wipro, they were that small, only 41%. Today, all the wealth is 73% is done by private sector. This is the real resurgence of Indian entrepreneurship. The whatever few listed multinationals are there like ITC, Lever, now Maruti also, and Lever, ITC, Nestle, and probably Maruti. These four are contributing to 12% of total wealth created, and we have just seen PSU, how small that has become. But I think this particular march of Indian entrepreneurship, which is an entrepreneurship mainly confined, except for IT and pharma, to domestic consumer needs, my sense is this entrepreneurship will become more ambitious and it becomes more successful, and the bigger opportunity is going to be for these companies to go global. And then you get a 30x, 50x opportunity for the companies which are competent and have the courage to really harness the potential in the global markets. So this is the celebration of Indian entrepreneurship, and that's one of the best things, and that's what we look forward to, our entrepreneurs making money for shareholders in a big way. Yeah, one of the things we saw is that the companies, I mean, this is slightly busy kind of a thing, but the top blue is, see, we have categorized the companies in 3 categories: mega, mid, and mini. So top 100 companies are considered as mega, and mid companies are 100 to 300, and from 300 onwards, all the companies are called mini companies. So the top row is the from in 2013, and vertical it is 2018. So from mid to mega, there are 16. See, the 3 performing segments are when the companies move from mid to mega, 16 companies. All of them, they are wealth creating companies, and they have given you 43% compounded. When the ranks change from, say, 250, rank 250 goes to become less than 100, that rank change actually is results, or the resultant return changes the rank. So this change of rank from 101 to 300, 16 companies have given you literally doubler every year. Only one company has moved, that is TVS Motors. from mini to mega. So that is 80% compounded. The 71 companies which are mega to mega, large cap to large cap, that has given only 15% return. So basically when you buy too much of large cap and there is no momentum, there will be some companies which have momentum, but largely as a bucket has created just about the market return in last 12% is the market return, and this has given about 15%. So there is not much of outperformance in 71 companies, only in those companies. Then the third category is companies which have moved from mini to mid. The companies, 46 companies, that has given 61% compounded. So it is not necessary for the large companies to move up. It is also important to see relatively small companies. I mean, if you see on the right side, the current sizes for number one company is 559 lakh crores right now. 100th company is about 28,000 crores. 300 companies, 7,000 crores. So basically anything below $1 billion today is considered as a mini company, and anything above between $1 to $4 billion is mid company, and above $4 billion is mega companies. So when the companies move in terms of sizes, you got to be watching, because HDFC Bank, I remember, was 800 crores, so $100 million company, maybe $150 million company. From there, year after year, to become now the largest, amongst the largest wealth creating companies. So this understanding of the rank change, and you can silently keep watching why this rank change is happening, and then go after that company. So this is the mid to mega. This is the segment, the 16 companies, where you find the companies are the leaders in their respective field, but they're not larger than life in terms of size. They're not lakh crore companies. I look at Bajaj Finance, Eicher Motor, Britannia, they're all leaders. Bharat Forge, they're clearly leaders, number one, number two in their segment, but they were literally small because opportunity might be small or their own profits might be small. So they are not 30,000 crores kind of a plus company, but they are 5, 6, 10, 15,000 crores company. Right now the scale has changed between 13 and 18, but they remain still not the mega companies. But still, in fact, these companies have both. They have the past track record of making money, and they have the huge runway to kind of grow. So, and if you go back here, look at this right hand, that basket. Here, the number one company is growing at 13%. The name of the company can change, but to remain number one, you have to keep growing every 5 years at the rate of 13% compounded, which is almost doubling in 6 years. So you have to remain number one, you have to keep growing. This is a crazy market where to stay in the same position, you have to grow at 13-14%. And at 100th position, if you want to maintain your position, you have to grow at 21%. At 500, if you want to maintain your rank at 500, you have to keep growing at 33%. So this is a crazy thing. As it keeps going down, your pace of growth is, I don't know whether this kind of stacking is there in other markets, but clearly this is quite staggering in terms of, because the growth of 8-9% or 12-13% nominal growth for year after year, I think this is the kind of stacking which happens, and opportunity in the mid to small cap which is there. We looked at the valuation metrics for this particular set of 100 companies, and here we found that below 10, whatever you bought, below 10 P multiple has worked. It has given you 33% return. But even 25 to 30 P you bought, that has also given 36% return. And overall, the average is about 24%. So we don't find it to be very insightful, except that fact that below 10 P, if you buy successfully, you make a little larger return. But if you have a payback, which is little looking into the future, if you buy for market cap below next 5 years forward profit added, in that case, of course, it requires a lot of insight and a lot of opportunity. I mean, one is the insight, second is the market level itself to be very low. So here, less than 1, that has been about 40%, and then 1 to 2 is 26, and then 20 and 21. So only 2 buckets have outperformed the 24% average, which is the up below 2 payback, which is about 1 PEG ratio, which is there, the next one. So what has happened is, if you do a PEG of a next 5 years, in that case, less than half PEG has given you 38%, and less than half to one has given 28, and rest all has kind of underperformed. So the markets are extremely intelligent, but they are not able to, the only place where market is not able to value it right is looking into the future in terms of growth rates. So I think that remains the only opportunity, but we will go in much more in detail in terms of where exactly the valuation of the market stands when we start the thematics. So the wealth destruction list, this is the very kind of prestigious list of this time. Wealth destruction is the smallest in last 80 studies, because we have done enough of destruction in the past, or it could be reflection of overvaluation of in general in the market. So only, see, your wealth creation is 45 lakh crores, but wealth destruction is only 5 lakh crores, 4.88. So kind of, there's not much of losses, at least till March. All the losses have come only after March. So this is the, I think this is going to change. We have to have, against 45-50 lakh crores of wealth creation, we have to have a very big list of wealth destruction of about 10 to 15 lakh crores. Can I just get water? So valuation insights, what works, what doesn't. So we have come to the theme. Again, there is, for investing, there is no substitute for paying the right price. So what is the importance of understanding value? So identify value price gap. See, in market, everybody knows the price all the time, but very few know, or they have the inclination to know the value, underlying value. Because price doesn't give any edge. How do you figure out what is the value? So a lot of people have no competence to figure out value, and a lot of people, I mean, at least the people who work in this tower, they have competence to value, but do they really bother about valuing companies? Because that's the biggest crisis. The people who are competent, they also don't bother about value. They only bother about what has happened to the price. So the way serious investing works is that price is always there. Figure out the value and buy only if there is a margin of safety. There is a huge gap between price and value. So we have done, as I said, we have done of the QGLP, we have taken care of Q, we have taken care of growth, we have taken care of longevity in last 23 studies. And this is the time when we are looking at price, reasonable valuation related to quality and growth prospect with a high margin of safety. So how the evolution of valuation itself has happened? So in 30s and 40s, when actually the first time anybody bothered to write about, there must have been some books, but actually security analysis came in 1934. And in 1938, Bud Williams wrote the book, Theory of Investment Value. At that point of time, there was a formal, some kind of writing in much more organized fashion about the valuation in the markets. And at that point of time, incidentally, there was a recessionary time, depression time, I think probably one of the worst depression. So that time, people wanted to buy the stock. Actually, nobody wanted to buy stocks. So the people wanted to buy stocks only post 1929 boom. They wanted to buy at discount to the book value. Clearly, if the book value is 100, I don't want to bid more than, the whole market was at discount. Then in 50s, when the economy started coming, this is in America, when the economy started coming out of the recession, they started saying, okay, we believe that company is going to work, but I don't want to buy equities unless the dividend yield is higher than bond yield. Dividend yield to be higher than bond yield in US. So if the bond yield is 8%, I want dividend yield to be 9%, 10%. Then only I'll buy. That went on for another 15, 20 years. Then they realized that the companies are not distributing all the earnings which they have. So then they said, let's look at the earnings growth because they're redeploying the profits. So then there was a boom in the valuation was based on the earnings growth, irrespective of the quality, irrespective of cash flow. And then Buffett and Manjar came, they said, don't look at only profits, let's look at the quality of cash flow, quality of profit. And there the quality investing started, See's Candy, Coca-Cola, American Express, all sorts of things they started buying. And they started also writing about investing in quality companies. And that kind of era lasted, or even it is lasting now. and investing in quality companies, and thousands of books has come. And then more recently, this is a Robert Hangstrom's summary. He's saying that new emerging, what you call valuation tool is CROCI, cash return on invested capital. We have not used this particular technique right now. Our own understanding is limited, but I think as we go along, we are going to explore even this possibility. So price is what we pay, value is what we get. So we can control what price we are paying only if we understand what is the underlying value. So present value, see, I think there is no confusion that the correct value, I mean the theoretical value or approximate intrinsic value, whatever you might say, the best definition and the only definition is present value of lifetime cash flows. The only problem in this definition is how do you figure out the lifetime cash flow. And so we have tried, everybody tries his own bit of trying to get approximately, everybody goes wrong, longer you go, more wrong you are, but I mean, I would like to be wrong on the right side. I mean, I estimate 1,000, but it turns out to be 10,000. Rather than I estimate 10,000, it turns out to be 1,000. So the whole effort is to figure out that approximate valuation of the companies. So intrinsic value for the bonds is very well defined, because here what happens is that you know the coupon rate, you know the tenure, you know the when are you going to get back the money. So when you all the things, there is no uncertainty. You can actually define a company, a bond which is 8% yield on 1,000 rupees. If you want to have yield of 10%, the price will be 877. You just put the numbers and the number will come out. So, but then equity is not that easy. Neither you have the fixed coupon, nor you have the fixed tenure, and you don't know even at what rate you should discount. So everything is kind of uncertain when you come to equity investing. And it is your choice what assumptions you have for all the three things. So we have tried to, so, you know, basically we were looking for a formula where, in fact, we wrote in studies, when we wrote about QGLP, we said we are looking at a triangle of 25% ROA, 25% growth, and 25 P. If we get these three, we knew that we are going to make 25% return without any problem, and index is going to do 15%. We'll have a nice margin of safety, about 10% outperformance. That's what the thinking. But we didn't know why we are saying 25P. I mean, should it be 20? Should it be 30 or 35? That now I think it will be much more clearer with and we found that QG and P is the best discussed, I mean, through the discounted cash flow. So here, this is slightly busy, but earnings growth rate of 20%, ROE of 25, and these are the only two variables, because your continuing growth rate, terminal growth rate is of 8% and cost of equity of 13. This is just so these two are, so if your earnings growth is 20% and ROE is 25, you see the free cash flow. Every year after year after year, the free cash flow is being built. Because you can make profit, but if your growth rates are significantly higher than ROE, or ROE is significantly below the cost of equity, so basically market is looking for massive source of free cash flow year after year. So here, if your ROE is 25 and earnings growth is 20%, you get nicely laid out free cash flow. Second is, if your earnings, the problem is here, the earnings growth is 30% and ROE is 14%. Then you see the negative negative flow of the cash, you keep building up, because your growth capex is building up at a very, very rapid pace. So what you are paying today of very high P multiple is for the free cash flow, which is probably, if at all it comes beyond 10 years of the life of the company. But people have, in the mood of optimism, people are willing to pay very high price for the free cash flow, which is likely to come way beyond after 10, 15 years. That is what exactly is happening in a lot of companies today. So basically, it is ROE, earnings growth, and cost of equity that determine the value triangle. So you have the ROE at the top, earnings growth at the one end, and the cost of equity. Once you have these three things, that's what you give the value, or you can determine value divided by price. I mean, the earnings divided by price, that gives you PE. So this is and all of them, I mean, like cost of equity, you can say is 12, 13%. Incidentally, cost of equity at 13% is the rate. Actually, we have the longest index is Sensex, which technically started from 7980, but actually started trading from 1st January 1986. So the index calculation before that is not very healthy, because the index moved by 7 times between 1979 and 1986. So obviously there is a lot of, it's not a good base. So but from 1st January 86, if you do it till date, it is about 13.5% compounded return for last 32 years. So we are saying cost of equity is about 13%. And even if you go by the other formula, 8 plus 5, 8% risk-free and 5% equity premium, that is about 13%. But I don't have a big grip over this. It could be 11%, 12%, that is a matter of discussion. But cost of equity is very important. Earnings growth, ROE, these 3 things you have to figure out. And then that will give us some kind of a numerical value number. And the way it works is that how ROE and growth determines. So, so the growth capex, where exactly the free cash flow comes? Basically, earnings growth minus the growth capex gives you the free cash flow. So the growth capex, if your ROE is at 20% or 25% or 15%, and if your growth rate is 20%, then delta PAT is 20% and 20 rupees. To earn 20 rupees, at 25% you need 20 bucks. At 20 rupees, you need 100 bucks. And at 15 rupees, you need 133. So you actually have, at one level of ROE, you have free cash flow, and at other level of ROE, that is 15%, you actually need to put more money. And these two makes a massive difference in the valuation of the companies, which market at times is not able to figure out the difference between high ROE company growing at the same pace and low ROE company which is growing at 15% or so. So that 15% requires a lot of capital to be inputted. So next insight is about all growth is not good. And this is very, at least I didn't know about, I was not so clear about this. If ROE is less than cost of equity, high growth destroys value. If the company is destined to make 11, 12%, which bulk of the companies do, they will never create value. They will never create value. And 60, 70% of the market is there. Today we'll show how big a portion of the market is stuck below 13, 14 P ROE. So if your cost of equity is 13%, if your cost of equity is 13%, at 10%, zero growth is the best. Because at zero growth, everything is free cash flow, there's no growth capex, and hence 1 by 13 is 770 is your value. But below that, if you start growing, you start destroying wealth. At 13%, irrespective of the growth rate, if ROE is equal to cost of equity, at 40% growth, 13% ROE, there are a lot of popular company today which are standing here, 12, 13% ROE and 40, 50, 60% growth. Actually, the P multiple should be 7 or 8 or 10 at best. They are trading at 40, 50, 60 P. And that is where either the ROE goes up or the valuation collapses. So this is what exactly is the... so all the growth is not good. What growth is good? Sorry. Yeah. So growth adds value when ROE is higher than cost of equity. So if you start with the third column, which is 15%, 20%, 30%, that is higher than 13%. So every column, at every growth rate, it starts creating value. So if ROE, if growth rates, so growth adds value only if ROE is higher than cost of equity. So this is slightly, so there are 3 things: ROE, cost of equity, ROE, and growth. All 3 works in tandem. So beyond a point, increase in ROE does not add much value. It took me some time to grasp this, but if a company is at 13%, of course there is no value creation, but it goes from 13 to 26. Look at the graph. Till about 40%, there is an very rapid increase in the P. But after that, from 40, you go to 400% ROE, or even 4,000% ROE. The P increase is going to be minimal, because free cash flow reaches almost 100% of the profit. And your profit, your free cash flow can never cross 100% of the profit. So hence, your gain in the value is going to be very limited. Your gain in the value can be only as much as you add in the free cash flow. So one has, so next is, earnings growth and valuations are exponentially correlated. The moment your ROE is higher than cost of equity, you just got to push the growth. Because after that, it is simply exponential. 12% growth, 24% growth, 36% growth, everything will be proportionally higher. And there is no limit. Of course, you cannot grow at a high rate for very high, long time. But earnings growth has that power. And that's why markets goes crazy when for 3, 4, 5 years, the growth rates go very high. Then the markets start giving crazy valuation, which they are right if the growth had continued. But we'll talk about it a little later. So low ROE companies should focus on raising the ROE. Low ROE companies should focus on raising the ROE, and high ROE company should focus on raising the growth. So look at carefully. 1% higher ROE gives you, 1% higher ROE gives you to high ROE company 1% gain. If you push the ROE beyond 30%. When you take it from 30% ROE, company A, to 31%, it will give you gain of only 1%. But company B, whose ROE is 16%, you raise the ROE by 1%, the value created is 12%. Now the next, the 1% growth, when the company is highly profitable, but growth is low, growth is at 10%, you grow it by 1%, it gives you 7% additional value. When the company B, where ROE is 16%, but growth is 20%, so 1% higher growth will give you only 3%. So basically the conclusion is, if the company is below cost of equity, the ROE, so basically what happens is, all the new companies in India, they push for right from day one for growth, growth, growth. Even we are also, victim of the same thing, where day one, people start building very rapid growth of 70, 80, 100%. And then what happens is, you have not built the, success model for making the profits. Look at Diageo, what they did. After acquiring for last 5, 6 years, all the analysts were pressing for growth. They didn't bother about the growth. They went about building the franchise. And now this quarter, they've declared 20% EBITDA margin. It may not be sustainable, but still, they are way above. They went about building it, all product rationalization, sales, marketing, branding, everything they said it right. Now they will focus more on the growth. So that is the way to go about it. And most of the successful companies, even I believe Avenue Supermarts, first 10 years, they built very few stores. They tested the model, and then when they found it to be working well, then they rolled out so many more stores. And they are going very, very methodically in terms of rolling it out. And so it is very important when you start growing and where the value, when the growth creates value. Sustaining high ROE is even bigger challenge. I used to think that high ROE companies will keep remaining high ROE forever. And there are a lot of companies. So we started from 1998, the companies which sustain ROE above 13% only, cost of equity. So in 1998, there were 136 companies. And every year, we kept on seeing the same companies at above 13%. How many companies are left? There were only 22 companies left. And this is the story you start from any year. So very few companies can sustain even 15, 17% every year, not for a very long period. And the companies and then hyper earnings growth is even more difficult. And this is another realization to me. I used to think the companies which are growing at 25, 30% in this growth economy will keep growing for 5, 10, 15 years. And that's what the market thinks. And that's how they build valuation of 100p, 80p, 90p, thinking that the growth will continue for a very long time. So here, look at in 98, just look at the first half, 5-year period. The companies with PAT growth of above 25% for 5-year period. So in 98 to 2003, there were companies with 20 crores profit. There were about 188 companies. Out of that, 28 companies had a more than 25% growth, average growth for 5 years. In the next bucket, between 2003 to 2008, it became 8. And in third bucket, from 8 to 13, it became 1. So where is the growth? I mean, high growth, it just doesn't sustain. And you do it on any period, 99, 2000, 2001, everywhere, by the third bucket, no company survives. And that one company is nothing but HDFC Bank. That was the only company which survived for 15 years of more than 25% growth. So it just, even if you do 3-year bucket, you see what happens. I mean, first bucket, second bucket, by the time it is third bucket, very little, and by the time it is fourth bucket, nobody survives. So basically, high growth phenomenon can last, even in this high growth country, for not more than 5-6 years. That is the highest. Now, when do you buy these companies? Do you buy when the growth starts? Before that, of course, you are the best guy, you will be featured in the fastest growing companies, and you will win big time. But if you buy after growth has started and 4 years elapsed, when the market is all there, P is very high, and you buy G plus 4, you know what is going to happen. You are buying right at the cliff. It will collapse. Literally, you can say that the company which is growing at 30-40% for 3, 4, 5 years, its days are counted, forget about the years. You know, just few quarters it is going to collapse. And then the market will realize and collapse the entire thing. So high ROE, high growth. You know, I mean, intermix of both is very, very rare. So we have seen this. You see this slide is very simple. This particular strategy works without any folly. I mean, QJLP is a thought process around this line. High ROE, high growth, bought at reasonable price. So that trouble is still there. We'll talk about it. But high ROE, high growth has always worked. It is summarized here. So high ROE, high growth has given consistently between 98 to 2018, every single periods of 5 years. It has given 27% return. The second is much surprising, but globally also this is a result. High growth, low ROE, reasonably low ROE, like more like 14-15% ROE, has given 21% return. And third lowest is the 14%, which is high ROE, low growth. They give just about the market return, because if you see average Sensex return this period is about 14%. So the only two outperforming segment is high growth, high ROE, high growth, low ROE. So that's the only way to make money. So growth is very important component of outperforming in the marketplace. So that was about valuation. Let's look at the pricing. You know, I mean, many times we are not able to figure out what is the valuation of a stock because we don't have clue about the what will happen, how much it will grow. But let's look at just the valuation, pricing, what works, what doesn't. So we have looked at price to earnings, price to sales, price to book, price to relative market, PEG, payback ratio, all the possible, whatever I have seen in my learning that we have done. And here we've seen, if you happen to buy, this is a 3-year alpha from 98 to 2015. So this is a 17-year, all the periods of 3 years we have taken, and all the instances are there. 4,000 instances are there. So whenever you bought below 10p, there is a good alpha of about 5%. But beyond that, it's all about market performance, or actually at various levels, you see the level of underperformance. So, if you buy above 50, 60p, you are literally not supposed to make money. Literally, I'm talking about if you buy all the companies, there could be one exception here and there. But if you buy above 50, 60, 70p, I don't think over a period of time it is going to make money. Look at the price to earning related to the market. If market is 21p today, and if you buy below that, then if you buy less than 1 time of the market, even that leaves a little bit of the alpha at about 4%, and there are 2,000 observations, 50% of wealth has been created during this period, but this is kind of a significant, I would say. So most of the time we don't know what is the P of the market. Right now P of the market is 21, so if you can buy decent company below 20p or 18p, I think you have a good chance of having some small alpha. The PEG, I'll just explain you, this is the PEG. Now, those are the ratios which we are kind of looking at today or past. But this is the ratio which is looking into the future, where your earnings forecast is coming into play. TTMP divided by future earnings CAGR. Today, it is such an unfortunate time. Most of people don't know what is the last 12 months TTMP. People, all the analysts, they talk about, now I think we talk about 20p, We don't even talk about 19P. So in fact, I have seen even my own analysts, they don't know what is the TTMP. And they know when they're sitting before me, first thing they should talk about is TTMP. So they have to do extra work to figure out what is the TTMP. Gautam, you have to be really observant about the TTMP. So TTMP divided by expected 3 years PAT CAGR. And so the real problem is the TTMP. Right now, TTMP is running at 50, 60, 70. So to make it look a little more attractive, they look at 20P, 21P, whatever. So, so this is how you calculate your 3-year PEG. So if you do a PEG of 1, it works very well. It works just brilliant. So at less than 1 PEG, the average 3-year alpha, not the return, average 3-year alpha is 19%. And 33% of all the observation, 1,300 observation out of 4,000 is below 1 PEG. So whenever you find below 1 PEG, pile on. I mean, this is going to give you massive amount of return, but of course you need the growth inside. And even up to 1.5 PEG has worked very well. But beyond that, it's just a disaster. And PEG 1, below 1 works across the time period. So we chose 3-4 of them, 2000 to 2005, when it was kind of coming from the peak of the one of the bull runs. At that point of time, alpha for 1 year was 13%, 2 year was 38, 3 year was 27. You see what has happened. But then the discipline has to be, I mean, this is the period in which index did very badly. Still, alpha was, I mean, even the PEG 1 companies were below, but the alpha was high. Between 8 to 13, that was the only year, 1 year. Between 8 and 9, 1 year, there was a negative alpha of 4%. Otherwise, you look at across the segments, the alpha is in double digit. Between 13 to 18, which is very recent, look at the alpha. If you could buy 17%, 39% 2 year, 3 years in 28, these are compounded alpha during that particular period. So this is staggering kind of result, provided we can practice it. Payback ratio is rehash of the PEG only, but it is more stringent in the sense that this is next 5 years profit. In PEG, you can have an inside of 3 years, but here you need 5-6 years of growth estimates. And here if you buy less than 1 PEG, I mean, of course you have 17% alpha. Price to book also works. If you are able to buy stocks at about 1 below book. So below book buying, I mean, this is like a Graham style. Very few worthwhile companies you'll find below book. But if you can buy below book, I think it works. Again, 5-6% alpha is there. Price to sales also works if you can buy good companies below one price to sales. So what works, what doesn't in pricing is all given here. In all the parameters, if you are able to do it one time PEG, one time payback, one time price to book, one time sales, below 10p or price related to market less than 1 time. I think everything has alpha of different order. But the best alpha is if you have 1 PEG, even 1 year inside, forget about 3-5 years, that's too long. But if you are sure about next 1 year's growth, and if you can buy it, say 30% growth, you can buy at 27, 28p, you'll still have a nice alpha. So this is what we have seen. And what doesn't work is more powerful. Look at it, anything you pay 3 times, and it just doesn't work. Above 50p has never worked. I mean, there could be one exception here or there, but what doesn't work is very clear. 3 PEG and this kind of thing. So these are the few very, right at the top is Avenue Supermart with 105p. Last 3-4 years growth has been fantastic at about 50%. If this company can sustain, incidentally, chairman of this company sitting here, so if it can sustain for next 5 years this kind of growth, of course this price is justified. But if you look at other companies, page 85p, this is yesterday's P. United Breweries is 82, P in hygiene. So this kind of P multiples, at least in the past, they have not made money. Now this could be a different time. And whenever we say this is a different time, you know what happens. So these companies are at crazy valuation. Are we buying at G plus 3, 4? Or we are buying G minus 1. I mean, is it the start of the growth period we are buying today? Or actually, bulk of the growth is done and we are buying at the end of it? So we have to be a little careful. Nestle is 62 P with 1% growth in last 3 years. And 3% in 5 years, 10 year is 11%. So we have to be very careful in terms of what kind of a growth are there and whether these companies will not sink. They will make a positive return, but they will be far lesser than even 13%, more like 8%, 7%, 12%. But they will not sink you because they are such fantastic companies. So current market valuations, let's look at this. I think this is more interesting. So 18% up from March to August, just 2 months back, and then 14% down from here. So between March and now, we are flattened to same 32,000 index. But more important is this, the 25% higher than long average period P multiple. So P multiple of Sensex for last 20 years is about 17. We are right now trading at 21, which was 24. This is after correction. We are talking about yesterday. We are trading at 21P, which is after the correction. It was more like 25, 26. This is the one which mostly you don't get to see. This is all market cap by all profits. All the 1,500 crores, 1,500 companies, total market cap, which is about 135 lakh crores, and total profits, which is about 4,60,000 crores. So that P multiple is 30 times. The average has never crossed beyond 17, 18. This is like ocean. The whole ocean is overvalued. So this clearly is little, eye-opening. The next is, if you removed, because state-owned banks are making losses, which could be one time, in the sense that ex-state-owned banks, total cap divided by total profits, it is at 24 times, which should have been about 17 times. Last, but this one is like crazy. So then we went about looking at the companies in 3 buckets, below 20P, 20 to 40P, and 40 to above 40P. In 3 buckets, we put all the companies which were above 1,000 crores between 98 and now. And in 98, just when the buildup was happening for the dot-com boom, 59% of the companies were below 20P. 26% was between 20 to 40, and 15% was above 40P. Already build-up had started. And it ended up in 2000 at 44, 29, 27. That neck kind of thing you see. 44, 29, 27. That was the peak of 2000. Then it collapsed. In 2003, when it collapsed, it was the worst of the market. Price to book of the market was about 1.2, 1.3 in 2003. And all the companies below 20P were 88%. Look at the top, absolute top, 88%. And below 20 and 40% was 12. And above 40 was 0. Look at that kind of extreme. And then the same thing happened again in 2009, in the Lehman kind of just before that. 80, 14 and 6. And from there, again in 16 and 17, more importantly, 18 March. Look at the neck again. 40, 30 to 27. In March, 27% of 700 companies were above 40P. It had to correct. But then inflow of the money was so strong that it held on to that level. And the moment flow stopped, last year we got 2.5 lakh crores of flow. And that flow has now moderated. And the moment moderation happened in last 2-3 months, you see the correction. The reason could be anything. ILFS, rating agency, NBFC, you can do whatever. But there's no buyer. That's why even those companies are not suffering from their mistakes. They are suffering from lack of buying. So now it is at 53% to 31 and 16. This is very close to the average. Average for last 20 years is 58, 29 and 14. So we have reached from the highs to the average. And so one round of correction is over. But this valuation calls for, even at this level, it calls for massive earnings explosion or fresh correction. So look at last 4 years EPS. It is completely static. Modi Saab came, that time EPS was, in 2014, was 405. And I think it's still at about 470, 480. It is all, corporate profit was about 4 lakh crores in 2014. Now it is 4,60,000 crores. There is not much of change. But then our valuations from 6,000 index, we went to 12,000. So the market re-rated big time. Now, as the flow has stopped, it is correcting back to the proper values. So this is very interesting time, and we think we could have slightly softer market for some time to come till the earnings build up. So in conclusion, the two key drivers of intrinsic value of return on equity and earnings growth. Companies create intrinsic value only when they earn ROE higher than cost of equity. Low ROE companies must focus on increasing ROE. High ROE companies should focus on increasing growth. PEG less than 1 is near infallible formula for healthy outperformance. Current market valuations demand robust earnings growth to justify current valuation, which remains elusive. Hence, expect market to remain soft. Thank you very much.